Good morning. A crazy turn of events, and the day hasn't even begun for Monday, March 23rd. Oil drops. Donald Trump announces a halt to Iran strikes for 5 days. Multiple deadlines around the whole Iran conflict today positively impacting the stock market. Today's Breakfast Club, Monday, March 23rd. I'm John Hutchinson with Traders Reserve. This episode is brought to you by the number one hit from the Bengals, Manic Monday. Let's see what's happening and get you on with your trading day. Uh, First, overnight, a tweet or Trump tweet from Truth Social that the U.S. and Iran have apparently had conversations, and that he was announcing a halt to strikes on Iran's energy complex for a period of 5 days, which would essentially be this week. Um, but there are other nuances to that. Again, let's keep in mind that a halt doesn't mean much until it really results in the end of the conflict. But for the moment, it's had a strong and positive impact. Significant reversals in the market. One, oil dropping at both the West Texas and Brent crude levels. Futures surging. Essentially, for all of the major indices, surging back above 200-day moving averages, which they had lost or closed below on Friday, even to the point of the Russell 2000 falling into correction territory. And so that clock starts today. But so there are two deadlines here. Actually, three. There are three deadlines. The first is obviously this new one from the halting of strikes for 5 days. Apparently, that's a negotiating tactic, negotiating period. Who knows? We will see. But the second is comes from a CFO conference. This was a story from CNBC, which appeared over the weekend, and we'll cover that in a second. And then the third is on if you're looking at put options and you really want an oh wow moment, you're going to want to look at put options on the SPY that expire on Friday, March 27th. That's this Friday. So strange to me that significant volume at key strikes this Friday, and this morning Trump comes out with exactly a 5-day window to try to, I guess, end the deadlock over the Strait of Hormuz. But we'll see. Let's start with the CFO Council call. This is to me the more difficult deadline for us as investors, as traders. CFO is essentially saying Trump has 2 weeks. He has 2 weeks to end the conflict or to open the Strait of Hormuz, because after that point, CFOs in the US cannot guarantee visibility into earnings, into revenue, into business, into labor, employment, borrowing money, paying money back, et cetera. In other words, the risks to business rise dramatically if this conflict extends beyond the end of March. So they're fairly clear about that. A capital advisor, John Kilduff, also on the call, essentially said if the conflict continues beyond April 1, you're looking at oil rising well above 100. The price in there was anywhere from 170 to 200. United Airlines CFO stating that he was already penciling in the 175 a barrel price for oil because he has to hedge the cost of oil. And airlines essentially have to buy oil far into the future to try to stabilize or normalize their cost of fuel over the long term. Southwest Airlines guys, because they basically their airline was born out of out of a group of oil traders. They used to be some of the best at hedging the price of oil. I don't know that they still are, but Herb and company at Southwest were really some of the smartest guys when it came to hedging the cost of fuel. At At any rate, at the moment right now, CFO is giving Trump essentially a 2 week clock. Fix this, or bad things are going to happen, essentially, is what they're saying. So now we have the 5 day halt, and we have a 2 week or 2 week deadline here from the CFOs. And then in addition to that, um, I'll take a look at the put options here in a minute. I mean, you can pull it up on the chain on your own platform. You look at the SPY puts for Friday, March 27th, and you will see some very shocking numbers at some key levels here. But for the moment, right, that's going to be Friday, March 27th. Keep your eye on what happens in the options market today. Uh, some of the premium volatility in the premium may pull back substantially, but this is all of these were significant reversals. I literally had to rebuild my entire deck at 8 a.m. this morning. My previous deck was all the bad news. Right now, this is green. This is largely good news. The one thing that I really was watching, gold was at one point down almost 10% this morning. It has recovered most of that overnight decline. So that's helpful. The 10-year note and 10-year yield was rising dramatically toward the critical level, which is 4.5%. If it pulls back and stays anywhere between 4.2 to 4.3%, that'll be stable enough for stocks to weather the storm temporarily. But overall, substantial gains early on in the pre-market for all of the major indices. We would not be surprised to see still volatile action in the markets, meaning open up, pull back, maybe another rise again as we get into the middle of the day, or as there are any additional clarifications about what the 5 day halt actually means. But for the moment, another roller coaster ride, and right now we're on the swing up. So we'll see how that plays out for the rest of the day. Here are the put options that I was referencing. The two largest strikes to watch are the 645 and the 625 levels. This is open interest at those levels. Having 100,000, almost 120,000 open interest contracts at the 625 level tells you that is institutions buying significant protection, 5% below current pricing, what was pre-market pricing before the market started to move higher, and secondary levels at the 645. So there is extreme worry requiring significant protection being purchased by institutions on the SPY. You likely would see similar numbers on the SPX. I didn't have visibility into the SPX first thing this morning. I was looking at the SPY and the Qs, and this is what caught my eye. So you notice that there's a trigger level here from 645 to 630 to 625. 630 was at 33,000 open interest. That's a significant spike in open interest volume. And those puts, the value of those puts were rising dramatically this morning. That is likely reversed, which I couldn't update before I went live here, but that has likely reversed since Trump's announcement, 7:30ish, when it hit the CNBC wires. So with that, the things that we need to be aware of as traders, because we're still stuck between the proverbial rock and hard place, and I'll keep this relatively simple. The weekend was filled with cross Atlantic threats, right? Trump saying, I'm going to obliterate that. Iran saying, we're going to obliterate something else. And the mutually assured destruction tweet war, I guess you could call it. Stepping back from that is at least a positive step. But unless or until ships are actually moving through the Strait of Hormuz, everything else is talk. So you be cautious about a Monday or one-day rally. We have seen this movie before over the last several weeks during the Investors Blueprint Live conference this week. I mentioned Mondays are rally days, and the rest of the week tends to be sell-off days. and that culminated in a significant sell-off on Friday. We're recovering some of that today. We may recover more than that today, but this is by the news, right? That's essentially what's happening here. So a 5 day pause on something isn't the end of the conflict, and does not change the underlying math around oil up, stock market down, oil down, stock market up. But I do think that the warning from CFOs is the more important warning than anything else. Institutions are clearly planning for the worst case, and if the market continues to move higher, then you might get actually a multi-day short squeeze, as those put options have to get bought back and institutions have to immediately switch from very bearish to at least neutral to bullish, based on Trump's 5 day halt. So the key here is that this is the entirety of the options complex here is institutional, not retail trader. These are significant directional bets that carried over from Friday, and likely would have led to the market opening with a significant gap down. Now it's reversed, but we will see if it holds, and that's the key problem. Now, the S&P, the SPY RSI had reached 29 after Friday's action, which is a level that is very rarely ever seen in the SPY, and is followed almost always by a significant rally, at least back to closer to neutral. So that maybe Friday was a capitulation point. If all things hold, then we can start building from here. But as I've said, even for AI2 people, I want a minimum of a 2 to 3 day stable move higher, not gap up moves, gap up, gap down. That's not stable. You need to have connected charts that show order. In other words, orderly movement higher, or even orderly movement lower. That just means stability is returning to Wall Street. Maybe sanity is returning to Wall Street. But a 1 day big move like today is no different than the one big move on Friday, just in opposite directions. So my takeaway right now is this is a yay moment. Yay, the market is recovered, but I will remain cautiously optimistic that this will play out well. But I also know from the last several weeks that we've seen sudden reversals to the downside. So I would like to tell you, this is the moment where you can just get all in and be ready to go. But if we know anything about comments from Trump, he will follow up a carrot with a stick. So the question is how Wall Street reads either the carrots or the sticks, and whether one is read as the dominant thinking or trend. In other words, more carrot or less stick, or more stick, less carrot. So it's going to be, expect a little bit of a challenge to start the week, but overall, at least a positive reversal from Friday, and on the back of solid news. We need to see how it plays out. I think that is really the only thing that matters. So if it's real, you'll see West Texas oil continue to fall back to or below 90. Oil may still be elevated or remain elevated in the short term, meaning oil was trading in the 60 to 70 range. It may trade in a 75 to 85 range. So it may still remain elevated, but that would still at some point result in a reduction in gas prices, a reduction obviously in oil prices. It's Wall Street and the economy can both overcome a 4-week spike. If we return at least close to near normal or average levels, things will balance out. And if that turns out to be the case, then that will put rate cuts back on the table because the short-term spike will have an impact to inflation. But if oil returns back to near normal levels, the Fed will ignore that spike. They will attribute any change in inflation in April and or May as sort of backdated noise related to the spike in oil and or gas prices. Um, the greater concern really has been inflation at the producer level, uh, as evidenced by 2-month increase in the PPI, and any continued rise in the consumer price index, the CPI, and or PCE inflation. And those are the metrics that the Fed relies on above all and before anything else. So at a minimum, this will at least put rate cuts back on the table. If there's no movement by the end of this week, you're back to the skeptical case, which is this is a 5-day head fake. Or at least a very short-term head fake, and then the war resumes, or strikes resume, or threats resume, and we would wind up finding ourselves right back where we were toward the end or latter part of last week. So, for the moment, we'll hope that it's the bullish case, that this is at least this is the first step in a winding down of the conflict, and if that happens, I think we start to see a sustained working back of the major indices and individual stocks. I I'd like to. I don't think that the stock market is going. I don't see the stock market just snapping all the way back to highs because the rate cut problem is still a significant economic headwind, and it is still a headwind for small caps. Right. So what you would see really is probably a return. Think of it as like a Fibonacci 50% return, a recovery. So we might snap back to a slightly higher level in the S&P and the NASDAQ, even in the Russell. But the Russell is still going to find itself down in the 5 to 8% range. So, we might still see the Russell down 2%, 3%. But any recovery is welcome and certainly gives more cover for decision making and more time for decision making. So I would continue to take a cautious approach with trades this week. Again, it's just all this is a pausing, right? Just like the tariff thing, right? I'm gonna put tariffs on Mexico, but I'm gonna wait. I'm gonna delay that for 30 days, right? It's the same approach. We'll see. We need to wait and see how it actually plays out. So with that, keep your eye on whether or not the move higher holds or whether there's an intraday fade. If that fades, you're looking, watch the first hour, and the 10:30 to 2 p.m. period is really the most critical. If the market holds higher levels in that 3-4 hour period, then this rally might have legs to extend into tomorrow. This is literally like taking the patient day by day and trying to recover, make a recovery for the patient one day at a time. If instead you see a reversal after the first hour, then Wall Street may have less belief that this will result in a winding down of the conflict and that this is nothing more than a delaying tactic. And if that's the case, then I think we have other issues. So also need to keep an eye on any signals from Iran that, yes, indeed, this walking back of threatening to destroy everything Iranian owns would result in opening the Strait of Hormuz. That would be a confirmation of Trump's post. And if so, then this rally really does have legs. The Friday, March 27th puts still really, really important point and levels. If we don't see the walking back by Iran to match Trump, that those puts become back in play, and you might see a significant re-reversal back to the downside, back to the 645, 640, 625 levels. That would be significant. And again, any extension beyond April 1, and you're likely to see oil start moving from 100 to 150 to 175 a barrel, based on projections from market participants like Mr. Kilduff here, who's was part of that CFO council. So oil is still the variable. The clock is what's new. We've got a 5-day clock. It is ticking, and any positive movement will extend the rally. Any negative movement will reverse the rally. The question is when those things happen. Don't be surprised if we get to the end of the week and we get another extension of the deadline. It is entirely possible. And whether the question then would be whether or not the market reads that as a legitimate and positive extension or not. So we got to go day by day. Positive start to the day, and basically let's see if it holds. I think yeah, for the moment. Thanks, Don. Good to see you, Don. Hope you had a good weekend. We will get the recording up here in just a little bit. We have the AI2 briefing later today at 4:00. Outside of that, I will be back next week, or if there's anything really critical happening this week, I'll schedule an additional breakfast club to keep you in front of everything. But for the moment, these are the things to watch. Nothing else matters at this juncture. So thanks for joining me. Hope you have a great trading week, and I will see you again next Monday.